Global markets are green across the board to end the week amid optimism over the prospects of the world's two largest economies. Now, starting in the U.S., and official data there showed consumer prices rose less than expected in October. Investors are taking this as a sign that the Federal Reserve will start slowing down interest rate hikes that have been choking economic activity. Now, stocks on Wall Street had their best day since 2020, with the Nasdaq surging more than 7%. Meanwhile, in China, Hong Kong shares are up close to 8%. That's after Beijing announced it was trimming its quarantine period for travelers entering the mainland. They're now required to isolate for just 5 days instead of the entire week. Now, for more, let's go to Craig Erlam. He's a senior market analyst at OANDA in London. Welcome back to the program, Craig. So a good day for stock market investors. Can you talk about this rally? Is this just a big knee-jerk reaction or a sign of something more lasting?
Yeah, quite incredible day, really, in US stock market. The Nasdaq rose more than 7%, the S&P around 5%. This is a phenomenal gain on the back of that inflation number. As you say, the question is it knee-jerk or is it sustainable? Or does the truth lie somewhere in between? I think it's probably an overreaction to one data point, first and foremost. That was a really good piece of data. It was lower than expectations. And also it was a sharp decline from where it was the month before. So from that, we can't ignore that. It was also widespread in terms of within the economy where this disinflation is taking place. So that's a positive point as well. But something that the Fed has repeatedly stressed, which we all need to understand, is that it is still one inflation point. And there's every chance that next month we could see that bounce back a little bit. So we need to see a series of data that shows that there is a trend forming and a sustainable trend and a sharp downtrend at that. This is an important first step towards that, but we shouldn't get too carried away. And it is going to be interesting to see over the coming weeks how stock markets perform in light of the fact that we've had that really good start, but that doesn't mean that we're going to see that sustainably. And it'll be interesting also to see what the rhetoric from the Federal Reserve is going to be as well. At the last meeting a week ago, we saw them suggest that we could see the slower pace of tightening from December, but they also suggested that the terminal rate, or the rate that we'll see it peak, the interest rates peak at, is likely to be higher than what markets are currently expecting. So a very mixed message. It'll be interesting to see what Fed officials have to say in light of this latest inflation report.
All right, so you mentioned the Fed there. So what are you penciling in for what the Fed might do next?
So I think 50 basis points in December is all but nailed on at this point. Of course, there's still plenty of data to come before we get to that. So things can change. There's all the normal things like the PMIs, jobless claims, etc. But there's also another inflation report the week of the Fed meeting in December. And there's a jobs report still to come before that. So there's still plenty of opportunity for the data to somewhat contradict maybe what some of the inflation numbers are saying. But I think what's actually happening here more likely is that the inflation data is finally confirming what we are already seeing elsewhere. We're seeing supply chains improve. That leads to lower inflation. We are seeing a little bit of slack in the labour market in that in terms of job openings are declining. So job creation is slowing. So that's creating a small amount of slack in the labour market. We are seeing from the surveys that economic activity is starting to slow, and the housing market has been slowing all year. All of these could help in the disinflation process. So the inflation number yesterday maybe goes some way to confirming what we're already seeing in some of the data, but we need to see more. So I think the Fed will slow the pace to 50 basis points in December. What comes after will depend on what the data says over the next 2 months.
All right, Craig Erlam, thank you for helping us not get carried away in London.